Education video on what we would consider CMBS or commercial mortgage-backed security lending. This is another lender type that we can possibly utilize. Sometimes they're called conduit lending because they're just a pass-through to a final destination. If you can kind of think about a conduit pipe. They're relatively new, been around for a long time, and it's really made to attempt to address virtually every type of asset class. Conduits are organized into pools of loans, similar assets, so $1 billion worth of multifamily, or $500 million of retail, and then what they'll do is they'll bundle those up and split them up and then sell them to institutional investors. The underwriting standards are set by the buyers, and they can often be quite limiting to borrowers with unique property types or borrowers that require more freedom to manage their cash flow. So there's a lot of documentation involved in the loan process and can be a little bit intimidating. The upside of these loans can be considerable. So they hedge in the secondary market, so there's risk mitigation. Conduits can offer rates at times, depending on the season, that are more attractive than traditional lenders. What I have found is that they're typically better at leverage than a life company or a bank. Generally speaking, but they're typically not as competitive on interest rate. Can happen, but they're just better suited for larger transactions. Someone's trying to push the envelope on leverage. That's a good place to go. They are, 99.9% of the time going to do non-recourse, which means the borrower doesn't have to sign personally. The fixed rate for 10 years, generally speaking. They will package these up and sell them off into the secondary market, typically speaking. Loans will range anywhere from 2 to, again, 50, 100, 200. The sky's the limit. They will do apartments, mobile home parks, anchored and unanchored retail centers, office, industrial, self-storage, and hotels. Their terms will fix for 5, 7, 10, and even 15 years at times. They'll do amortizations of 15, 20, 25, and even 30 years. And their prepayment penalties, 99% of the time, are going to be defeasance or yield maintenance. Here's a really simple way to think about this. When they give you an interest rate, so let's just say it's 4%, for sake of discussion, and it's a 10-year fixed loan. If you go to pay that loan off, let's say that it's a $5 million loan, and let's say it's a 10-year term. If you pay it off in 5 years, so think about it, there's 5 years left on the loan. What they'll do is they will go out into the market and look at the 5-year treasury bond, and they will determine how much they can make in that by replacing it with the rate. So let's say your rate is 4%, as we mentioned, and the 5-year treasury is at 1%. There's a 3% gap. So they are only going to make 1% with the new money versus making 4%. So if you think about it logically, they're going to lose money by paying your loan off. And so what happens is they'll say, Mr. Borrower, that's fine. You can pay that off, but here's the reality. You're going to take the loan amount. So let's say the loan amount left is $2.5 million. They're going to take that amount multiplied by the 3% differential. Okay, so if you start doing the math a little bit on this, it could get really, really expensive. So $2.5 million multiplied by 3% is $75,000. Then you take that multiplied by the amount of years left remaining times 5, that's $375,000. Now, that's not the exact calculation, but that's typically how it is calculated. So you can imagine the wider the gap, the more expensive it is. And the longer it is to maturity, the more expensive it is. So anyways, that's why it's really important to notate that the borrower really understands what they're getting into, because you don't want them to wake up one day and go, what? I'm going to have to pay that much? So conduit lenders, again, they'll issue an application after they underwrite. Um, I'm not a huge fan of them just because they're so tied to the stock market that if all of a sudden it gets wonky and you have a difficult time, um, with the market going way high or way low, it could jeopardize the loan where the interest rate gets changed dramatically, the terms get changed dramatically, and we've had pandemics happen before, recessions, where they'll literally just decline the loan towards the end, or they'll just pull out of it. So it's just something to be really aware of, and be very cautious of when you're doing these types of loans. We're because it's not always the best thing for the borrower. So those are CMBS loans, commercial mortgage-backed securities, and it's a product that we utilize.